Okay, afternoon, students. I hope you are all well. So this session is going to be a revision session for your assessment coming up next week, Wednesday. Can someone just confirm that they can see the slides that I have shared or the document that I have shared? Okay, great. And I'm assuming you guys can all hear me okay? Okay. Hopefully you have the documents in front of you. So for your assessment, you know the scope of the assessment, okay? So you know that your assessment will include PPE, it will include borrowing costs, it will include intangible assets, and it will include the first part of financial instruments, okay? So because you have done PPE already, and in the first revision session we had for test 1, we went over a PPE question, it doesn't make sense for me to revise PPE, okay? So I'm going to be doing a revision question on borrowing costs, a small revision question on financial instruments, and a small revision question on intangible assets. So even though I'm not revising PPE now, it doesn't mean it is not important, okay? So no spotting for the assessment. You need to study everything, okay? And if you don't, then you may not pass, okay? Which we obviously want you guys to pass, and we want you to all do well. So just a word of advice, don't just look at what I'm covering now. It's important that you include the previous topic, PPE, that you did previously, okay? So let's have a look at the first question. Not sure why it looks so small, but let's have a look at it. So this is a question on borrowing costs, and this is taken from last year's second assessment. Two Cousins Catering is a company based in Soweto. The company applies full IFRS to borrowing costs. Okay, can you not see the screen? Let me just unshare it quickly, and then I have zoomed in. Okay, is that better? Is that better? Let me just stop sharing it and just see if I can get a bigger copy quickly. Okay, well, if you have it in front of you, just have a look at it so long while I just try to fix this. I think I know what the problem is. Okay, let me just quickly add a better version of that file. Okay, can you guys see? I've shared this one. I don't know why it's still so small, but let's just go in a bit here too. Okay, is that all better? Okay, so let's carry on. So in this question, we have a company called Two Cousins. So Two Cousins Catering Company is based in Soweto, and the company applies full IFRS for borrowing costs. So the company has a financial reporting date of 31 December. During the current reporting period, 2018, the company decided to expand their operations by constructing a wedding venue for hire. So in order to fund the project, the company obtained a 2 million rand loan from ABC Bank. So the funds were in TCC's bank account on the 1st of April 2018. So we received the money on the 1st of April 2018. The construction of the venue started on the 1st of July 2018. The capital amount on the loan will only be payable after 2 years once the venue is completed and is generating income, which will be in 2 years' time. However, the interest of 15% on the loan is payable annually. So apart from the loan from ABC, the company has an overdraft facility to the value of R500,000 that can be utilized for the construction should the need arise. The interest rate on the overdraft is 10% monthly. Since there was still enough cash to cover the construction costs in the current year, the overdraft was utilized to pay salaries on the 30th of November 2018. The estimated costs for the construction of the wedding, sorry, let me just go down. I don't know why this isn't scrolling down. I don't know, sorry guys, this is just not going well today. I'm scrolling down in the Word document, but it doesn't seem to be working. Okay, let me just stop sharing. I apologize. I'm not sure what's going on. Okay, I'm just going to reshare it. Okay. So we stopped over here where we spoke about the specific loan of 2 million rand. So apart from the loan from ABC, the company has an overdraft facility of R500,000 rand that can be utilized for the construction should the need arise. The interest rate on the overdraft is 10% monthly. Since there was still enough cash to cover the construction costs in the current year, the overdraft was utilized to pay salaries on 30 November 2018. So the estimated costs for the construction of the venue is 2.5 million. As of 31st December 2018, construction costs of 900,000 have been paid as follows. So 500,000 was paid on the 1st of July 2018, and 400,000 was paid on the 30th of November 2018. Okay. So now that we have the information, obviously they have given you a whole lot of information, and by looking at the required, you should be able to see that this question is on borrowing costs. Okay. So if we have a look at the required, let's just go back. So the required says, state whether the wedding venue is a qualifying asset or not, and give reasons for your answer. So who can assist me here? Does the wedding venue qualify as a qualifying asset? Remember when we did the lecture on borrowing costs, we said that not only does it have to meet the definition of an asset, it also needs to meet the definition of a qualifying asset. So what is a qualifying asset? Can anyone remember? Okay, so remember, a qualifying asset is something that is going to take a substantial period of time to get ready for its intended use or sale. So does this meet the definition of a qualifying asset? So remember, I'll just repeat that. A qualifying asset is an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. So is this a qualifying asset? We're talking about the construction of the wedding venue, and they told us that this is going to take around 2 years until it is ready. So yes, because it is going to take 2 years to get ready, and you guys are all correct, I can see all the yeses. So because this is going to take 2 years to get ready, then yes, this meets the definition of a qualifying asset. Okay, so you needed to mention that yes, it is a qualifying asset, and you needed to mention why. You needed to say that the wedding venue is going to take 2 years to build, therefore this is a substantial period of time, therefore the wedding venue is a qualifying asset. Okay, so if we move on to the next question, the next question says, when does capitalization of borrowing costs end as per IAS 23 borrowing costs? So when does the capitalization of borrowing costs end? Okay, so we need to have a look. When do we decide that we may no longer capitalize the borrowing costs? And remember in the lecture, I know it was last week, so maybe you've forgotten, so the capitalization of borrowing costs must end on something called a cessation date, okay? So when something is ready for its use, that is called the cessation date, okay? So when the wedding venue is ready for its intended use or sale, or is substantially completed and capable of being used or sold, then we have to stop capitalizing the borrowing costs. Okay. So I can see your answers, Shezi and Zinkume. Thank you very much. So those are the first two questions. So those are little theory questions. Usually an assessment will have a combination of like a little bit of theory and also calculations. Okay, it's important that you not only can do the calculations, but that you also know how to answer a discussion question. Okay, so let's move on to 1.3. Now that we've done the discussion questions, we can have a look at a calculation-based question. So calculate the amount of interest that should be capitalized for the reporting period ended 31 December 2018. So we need to decide how much of this interest are we going to capitalize. So the first thing we need to do is to identify in our question what sources of borrowings do we have. So if you have a look here at the question, what sources of borrowings do we have for the wedding venue? They told us about a 2 million rand loan from ABC Bank. This is going to be used to fund the project. Is this an example of a specific loan or a general loan? So this 2 million rand, it says here it's going to be used to fund the project. Is this an example of a specific loan or a general loan? Okay, it is a specific loan. Well done, everyone. This 2 million is a specific loan, and the reason it is a specific loan is that it is going to be used to fund the project. Okay, it is specifically going to be used for the construction of the wedding venue. So it is specific. Let's have a look. Was there any other source of borrowings that they told us about? They said here, apart from the loan, the specific loan that we saw just now, the company has an overdraft facility to the value of R500,000. So this can be utilized for the construction should the need arise, okay? So this overdraft, is it an example of a general loan or a specific loan? So this R500,000, it is an overdraft. It may be utilized for the construction if the need arises, but it is not specifically for the construction of the wedding venue. So yes, you are all correct. This R500,000 loan is going to be a general loan. So now that we have identified our specific loan and our general loan, the next thing we need to ask ourselves, how much did we use from this general loan? So it says here the interest rate on the overdraft is 10% per month. Since there was still enough cash to cover the construction costs in the current year, the overdraft was utilized to pay salaries. So was any of this general loan used to pay for the construction costs, or was it only used for salaries? So they mentioned in the question there was enough cash to cover the construction costs in the current year, being 2018. So if we had enough money from this specific loan, then we can see that we didn't actually use any of the overdraft for the construction of the wedding venue. So the overdraft was only used for salaries in the company. So therefore, even though we have this overdraft available to us, no amount of interest on the overdraft will be capitalized to the wedding assets. And the reason for that is that no amount of this overdraft was used in the construction. Okay, so we've got our specific loan. This was used to construct our wedding venue and to pay for our amounts during the current year. During the current year, we didn't have to utilize our overdraft. So therefore, the interest we are going to capitalize is going to relate purely to the specific borrowings. Okay. So let's have a look at our calculation. So that's just the calculation, the theory for the first two questions. But let's have a look at this calculation here. So we need to calculate the interest expense, the borrowing costs that we can capitalize to our qualifying asset. So if we go back to that slide, you'll see that the amount of the loan was for 2 million rand, and they told us that the interest rate of that loan was 15% payable per annum. But how many months are we able to capitalize the interest expense on this loan to the qualifying asset? How many months are we going to be able to capitalize? Okay. Is that better? Okay, I've zoomed in a bit. So my question is, and I can see a lot of you are answering already, how many months are we going to be able to capitalize the interest expense on the borrowing funds? And you are correct, it is 6 months. So even though we got the loan on the 1st of April, okay, I'm not sure, people are saying they can't see. I'm not sure why. if it's just maybe my device or your device. I can see my device clearly. Please can someone confirm if they can see the question clearly? I have zoomed in as much as I can. Okay. So the reason why it is 6 months is that even though the loan was taken on the 1st of April, construction only began on the 1st of July 2018. So we cannot capitalize the interest on this loan when it was taken, because remember, in order to capitalize the interest, we need to have started construction. Okay, so it looks like people can see it. Maybe you could try zoom in on your side just to make sure that it is clear. Okay. So the construction began on the 1st of July. So this is the date we can capitalize our interest from. So if we go July, so the month of July, August, September, October, November, December, that is 6 months. Okay, I just counted 6 months on my fingers. I highly suggest you use your fingers when you count months. It helps for accuracy, okay? So the construction of the venue began on the 1st of July. This is the date that we can capitalize the interest from. So from 1st of July to 31st of December, this is going to give us 6 months. So remember, the required said, calculate the amount of the interest that should be capitalized for the reporting period ended 31 December. So we are simply going from the 1st of July, which is when construction began, to the 31st of December, which is the end of the year. So you should all agree that that is 6 months. So here you can see the interest we are going to include in our calculation is 2 million times 15%, which is the rate per annum. And then because construction began on 1st of July, from 1st of July to 31st of December, it is 6 months. So this is going to give us a borrowing cost amount of 150,000. Okay. But now remember, a portion of this borrowing costs may not have been needed for the whole year. Okay, sorry, let me repeat that. The loan amount of 2 million, that is a specific loan, a portion of this may not have been needed for the whole year. So when we have cash that is not needed, it is basically considered surplus to the company's operations. Okay, so any cash that is surplus, it makes sense that this cash is invested to earn a positive return like interest income. So in our question here, if we go back to our question, they told us at the bottom of the question, all surplus funds were invested in a money market account at a rate of 1% per month. So we need to identify, was there any surplus funds during the year? So we got the loan on the 1st of April of 2 million. And when construction began on the 1st of July 2018, that 2 million rand was not payable immediately. Okay. So the payments we made out of that 2 million was 500,000 on the 1st of July 2018. And then 400,000 on the 30th of November 2018. So we need to ask ourselves, how many months was there surplus cash? Okay. So if we have a look at the interest income rate, it is 1%. My question to you is that they have given you 1%. Is this an annual rate or a monthly rate? So this 1% that you are going to use on your surplus funds, this is a monthly rate. Okay, correct. I just wanted to point that out. So now let's calculate our surplus funds. So we had 2 million, okay, and we paid 500,000 on the 1st of July 2018. Okay, this is my 2 million rand. So how much is surplus over here? We only paid 500,000 rand out of that 2 million. So what is the surplus cash at the 1st of July 2018? What is the surplus cash if we had 2 million rand loan? This money was deposited into our bank account on the 1st of July 2018. So it was debit bank, okay, credit loan. Then we use 500,000 rand of this 2 million rand to pay for our construction costs on the 1st of July. So my question is, how much is surplus? Well, the surplus amount is 2 million. Thank you, everyone. Thank you, everyone, for your answers. Colonel, I think you've answered 20 times. Well done. Okay, so 2 million minus 500,000 rand, that is 1.5 million. That is surplus until the 30th of November 2018. Okay, so that's 1.5 million, like you guys identified as surplus cash. How many months was that surplus for? So that surplus cash of 1.5 million, how many months was that surplus for? So we need to count from July to November. So we're going to go July, August, September, October, and November. So you will see that it is surplus for 5 months. Okay, that is 100% correct. So if we have a look at the solution, you can see that we have included the interest income up until 30 November as 1.5 million multiplied by the 1%. Remember, this is a monthly rate, not an annual rate. And then we multiply by 5 months. So because that 1% is a monthly rate, we need to multiply that by 1%. Sorry, because that 1% is a monthly rate, we need to multiply that by the number of months. If that 1% was an annual rate, then we would have taken that 1% and multiplied it by 5 over 12. But because that 1% is a monthly rate, we are going to multiply that by 5. Okay. Then we need to have a look at our next payment. So our next payment happened on the 30th of November 2018. So on this date, 400,000 was paid. So on the 30th of November 2018, what is the amount of surplus cash? Remember, we started off with our 2 million rand, and then we paid 500,000 rand. Okay, I see someone has a question. Why are we calculating till November and not December? That is an excellent question. We are calculating until November because on the 30th of November, we had a further payment. So our surplus cash amount is going to change on the 30th of November. Okay, so we are going to December, but our surplus cash on the 30th of November is going to be different to the surplus cash from the 1st of July. So remember, the loan was 2 million rand. We paid 500,000 on the 1st of July, and then on the 30th of November, we paid 400,000. Okay, so this is our payments. So what is surplus? If we go 2 million less 500,000 less 400,000, what is the amount of the surplus cash? Okay, it is 1.1 million, which is correct. I can see a lot of you got it correct. Okay, it is 1.1 million. And remember, our interest rate is 1% per month. That is the interest amount we are going to receive. So if we calculated the surplus cash as 1.1 million on the 30th of November, then we need to realize that it is 1 month until the 31st of December. So this is going to give us an interest rate. So if we have a look at our solution here, okay, I see there are chats. I'll get to that now. Let me just show you the diagram here. So we have our borrowing cost. This is our interest expense. And then we have our interest income, which was earned on our surplus cash. Okay. We obviously need to have a look at when our payments were made, as this is going to affect the balance on the surplus cash. When we take our borrowing costs, this is our interest expense that we can capitalize. Then we subtract our interest income. This is going to give us our net amount over here of 64,000. This is the amount that can be capitalized. Okay. Okay, someone is saying, why are we using 1% and not 10%? So if we go to the question, remember we are looking at the surplus cash. That rate of 10% given to us, that is for the general loan. But we are not worried about the general loan because the general loan was not used at all for our construction of the wedding venue. So the rate we are using for our interest income is 1% per annum. Okay. 1% per month. So that is why we are using 1%. We are simply looking at our surplus cash. And this is the amount of the loan that is not going to be paid immediately. Okay. So that answers your question, Rue, or Aru, I'm not sure how you say it. How did we get our 900,000? Thank you, Ms. Singner, for answering. And Nikita, why are you using 900,000 and not 400,000 for November? Because remember, we're starting again at the 2 million rand here. If we had gone 1.5 million as the starting point, then we could have subtracted the 400,000. Okay, you'd get the same answer. So someone is asking, why are we showing the interest in the bracket? Okay, it's because remember, your interest expense and your interest income, they're opposites. So here, the brackets don't necessarily represent a credit, but we are simply showing that we are subtracting the interest income from the interest expense. And that is going to give us the net amount of borrowing costs to be capitalized. So the brackets here are simply showing that we are subtracting the interest income from the interest expense of 150,000. Okay. Okay, so I think someone is asking, how did you calculate the answer to 175,000? This is a bracket here. Okay, this is a bracket. It's not a 1. Maybe you could just try zoom in a little bit more. Okay, guys, let's move on. We're a bit short of time today, unfortunately, but let's have a look at the next required. So the next required says calculate the finance costs. Okay, someone asked, why did we invest the 2 million? And someone is asking, why did we invest the 2 million in April when we got it? I think you might be saying, why did we not invest it in April? Even though we got the money in April, construction only began on the 1st of July. So even though that money might have been invested earlier, you can only take it into the calculation from the construction date of the 1st of July. Okay. So the 2 million rand was received in April, but because construction began on the 1st of July, you can only take any of the interest from that date, whether it's your interest expense or your interest income. Okay. Remember, in order to capitalize the borrowing costs, you must be constructing your asset. So the construction only began on the 1st of July in the question. So this is the date that you need to take into account when calculating the interest expense and the interest income, and the net of those two will be the amount to be capitalized. Okay. So let's have a look at the next required. The next required says calculate the finance costs to be included in the statement of comprehensive income for the reporting period ended 31 December 2018. Now, what I want you to understand is that the interest to be capitalized to the qualifying assets is not going to be all the interest expense earned for the incurred for the year. Okay, let me repeat that. That loan was taken out on the 1st of April. We're incurring interest expense from the 1st of April. Okay, so our interest expense is going to be from the 1st of April 2018, but only a portion of that can be capitalized. And remember, I said construction began on the 1st of July 2018. So only from this date, any interest expense incurred after this date, the 1st of July 2018, relating to the construction of the wedding venue, only this can be capitalized. Okay, only this can be capitalized over here. But our interest expense is incurred from the 1st of April 2018. So we need to understand that our interest expense in our accounting records, like our journal entries and our statements of comprehensive income, is going to be our interest expense from the 1st of April 2018. However, only a portion of that will be capitalized. And the reason is that it cannot all be capitalized is because construction began at a later date. We can only capitalize at a later date. Okay. Okay. Let's finish this question and then I will come back and answer your questions. Okay. I just don't want to keep going back and forth because then we're all going to get confused. So let me finish this question and then I will answer all of your questions in the chat. So we need to calculate the finance cost to be included in the statement of comprehensive income for the reporting period ended 31 December 2018. So if we go to our solution, remember now we need to calculate our total interest expense. So the loan was granted on the 1st of April. We received this on the 1st of April. Of 2 million. Our annual interest rate is 15% per month. What is the period out of the year that we had this loan for? How many months out of 2018 did we have this loan? So I'm asking you, when did we receive this loan? And the date we received it was the 1st of April. And the year end is the 31st of December. So I'm trying to calculate my total interest expense on this loan, and then we're going to subtract the interest that we calculated previously, as this amount is going to be capitalized. Okay, so from April to the end of December, from the 1st of April to the end of December, this is 9 months. Okay, so do you agree this is going to give us our total interest expense? And then a portion of this interest expense incurred on that specific loan is going to be capitalized. So we then need to subtract it because it is going to be capitalized. Okay. So if we have a look at that 2 million, we are simply multiplying it by the annual rate of 15%. This was an annual rate. So we need to ask ourselves, how many months out of the year did we have this loan? And we had the loan for 9 months, okay? But remember, a portion of that 9 months, for 6 months, we were constructing our assets. So we need to take out that interest of 64,000. This amount is going to be capitalized, so it is not going to be included in our finance costs in our statement of comprehensive income, okay? It comes in and then it goes out because this is going to be capitalized, meaning we will debit our asset with the 64,000 Rand, okay? So that is going to give us interest on the loan of 161,000 Rand, okay? So remember, the required is asking us to calculate the interest expense that is going to be included in the statement of comprehensive income. So even though previously we were looking specifically at the construction of the wedding venue, do you agree if we look at the total finance costs for the company as a whole, The specific loan is not our only finance. It may be our only finance for the construction of the wedding venue, but it is not our only loan. We also had an overdraft of R500,000. So this overdraft of R500,000, it had an interest rate of 10%. If you have a look in the question, that interest rate is 10%. And if we go back to our question to see how long we had that overdraft for, so it said here, since there was still enough cash to cover the construction costs in the current year, the overdraft was utilized to pay salaries on 30 November. So we took out that overdraft of R500,000 on the 30th of November. So if we took out the overdraft on 30 November 2018, how many months did we have that overdraft for? The facility was available, but we only withdrew from that facility on the 30th of November. So we essentially had the overdraft for 1 month. Okay, so let's go to our overdraft here. So our overdraft is going to be for 1 month. And remember that interest rate they gave us was a monthly interest rate. It is not an annual interest rate. So in order to calculate our overdraft, we are simply going to go R500,000 multiplied by the monthly rate of 10%. And then how many months was it? As most of you got, it was 1 month. So that will give us the interest expense relating to the overdraft of 50,000. Okay, so that 1 month is the overdraft was taken on the 30th of November, and we're trying to calculate our interest expense on the 31st of December. So it is basically the month of December. So this one relates to the 1 month of December. So our total finance cost is going to be 211,000. Okay. So let's have a look now. You think about that while I go and have a look at your questions quickly. Let me just see where we stopped. Okay, so someone is asking, where does the 5? Okay, so someone is asking, how would the carrying value of the qualifying asset be calculated? So we would take all of the construction costs that we are spending on the asset, and then we would add on this amount of 64,000 Rand over here. Okay, so at the end of the day, our cost is based on all of the costs incurred in order to bring the asset to its current state and condition. So whatever is spent on the construction, that's going to be capitalized. And then also this amount of 64,000 Rand, which is the interest portion, the net borrowing costs, that will be capitalized. Okay, so someone is asking what happens with the 3 months from April to July. Okay, the loan was only taken on April, but the construction costs only began in July. So we can only capitalize from July onwards. Okay. Someone is asking, why are we subtracting the 64,000? So this 64,000, this relates to the interest that is going to be capitalized to our qualifying assets. So we are trying to calculate the interest here, our total interest expense per our statement of comprehensive income. So do you agree that over here, this is going to include all of our borrowings, okay? So it's going to include our specific loan and our general loan. So we calculated our total interest expense over here on the 2 million Rand for the 9 months, but a portion of this interest expense actually relates to the interest on our borrowing costs relating to the construction of the assets. So because we are going to capitalize the 64,000 Rand, we need to subtract it because we're taking it out of our interest expense and we're going to be debiting our asset, our wedding venue asset. Okay, I explained how to determine the 1 month. Okay. Someone has asked, why are we using the 1%? I'm assuming you're referring here to the interest income. So remember, this 1% is a monthly rate. That is why we are using 1%. It is a monthly rate given to us. They told us that surplus cash will be invested at 1%. That is how much we are earning. Okay. That should be that question. Okay, so at the end of 31 December 2018, the carrying value of that asset would be 900,000 plus the 64,000. That is correct. Obviously, we won't start depreciating it yet because it is not ready for its intended use. Okay, so someone is asking, the borrowing costs we are capitalizing, is that the money we are receiving? It's not really the money we are receiving. It is the net of the interest expense and the net of the interest income relating to the surplus funds. It is the net of those two. We're actually paying this amount on the loan, but because that loan is going to be used specifically for our construction assets, then we can capitalize that to our qualifying assets. Okay. Okay, guys. Okay, I feel like I'm answering the same questions over and over, but this is the last question I'm going to answer. So someone is saying, why did we not invest the surplus cash? Well, the surplus cash can only be invested from the date that construction started, okay, which is the 1st of July. Okay. Okay, guys, if you have any questions on this, I think go through it. The first time you see something, it's always a bit different and a bit new. But when you go over again, that's when you'll get a greater understanding. Okay, you're welcome to email me if you have any questions. But we do have 2 more questions to go through. Okay, they are not as long. So let's just have a look at these questions. Okay, so the next question is on financial instruments. And I know you guys might have not have a deep knowledge of this because this was only just done this morning. And that is okay, but I'm going to go through this simple question on financial instruments. And then what I recommend is that you go home and you do your practical question that should be on Blackboard, okay? So let's go through this question of financial instruments. This should be based on the work you covered today. So we have a company called Hlula, is a property development company based in the East Rand. The company has a reporting date of 31st December. During the current year, the following transactions took place. On the 1st of March 2017, Hlula bought 100,000 Class A shares in Lifa Limited for 2 Rand per share. There were no transaction costs as it was a private share purchase. The shares were trading at 2.50 Rand on the 31st of December 2017. On the 1st of June 2018, the company was in need of cash urgently and decided to sell 20,000 of the shares in Lifa Limited for 2.20 per share. On the 1st of September 2018, the company bought an additional 10,000 Rand shares in the same company at 2.30 Rand. Lifa Limited shares were trading at 2.80 Rand per share on the 31st of December 2018. The shares are to be valued at fair value through profit and loss. Okay. It looks difficult, but it's not impossible. Okay. So let's have a look at what the required says. Prepare the journal entries to account for transaction 1 in the books of Hlula for the financial reporting period ended 31 December 2018. So we need to identify all of the transactions relating to the 31st of December 2018, okay? So you'll see that I've highlighted 2.5 lines here. This information they're giving us, although useful later on, it isn't going to result in journal entries for the 2018 year. we need to look at the information given relating to 2018. So the fact that Lula bought 100,000 Class A shares in 2017, it would have resulted in a journal entry in 2017, but we are only concerned with journal entries relating to 31 December 2018. So the first journal entry I can identify is that on the 1st of June 2018, the company was in need of cash urgently, and they decided to sell 20,000 of the shares in Lifa for R2.20 per share. Now, who can tell me what your debit and credit is here? If we are selling shares, remember, we show the shares as an investment in Lifa. So an investment is going to be an asset. Here, we are selling some of our investment. We are selling 20,000 shares in Lifa, and we are going to be receiving some money for those shares. So who can tell me what the debit and credit of these journal entries are? Okay, I can see a lot of you are getting it correct. We are going to be receiving money. So we are going to be debiting our bank account, okay? Our bank account is increasing due to the sale of these shares. So we're going to debit our bank account, and then we're going to credit our investment in shares. So remember, our investment is getting smaller. An investment in Lifa is shown as an asset. So our investment is actually getting smaller. So we're going to go debit bank, credit our investment in the shares. And I see some of you have said the amount. We are going to calculate the amount by taking 20,000 of the shares, as this is what we are selling. And we're going to be multiplying it by R2.20. Okay, so that is correct. We're going to be debiting our bank with 44,000 Rand, and we're going to be crediting our investment with 44,000 Rand. Well done to all of you who got it correct. So that was on the 1st of June. On the 1st of September 2018, the company bought an additional 10,000 shares in the same company at R2.30. So previously we were selling shares, now we are buying shares, okay? We decided to buy 10,000 Rand or 10,000 shares, sorry, it's supposed to be 10,000 shares in the same company at R2.30. So what are our journal entries going to be here? Can anyone assist me with the journal entries now that we are buying 10,000 shares? Okay, now that we are buying our shares, do you agree our investment is getting bigger? So because our investment in Lifa is increasing, we are going to be debiting our investment in Lifa. It is getting bigger. And because we have bought these shares, when we buy something, you know that there's likely going to be a cash outflow. So we are going to pay for these shares using our bank account. So our bank account is reducing. So we are going to go debit investment and credit our bank account. And can anyone tell me the amount of this journal entry? How much are we going to debit our investment and credit our bank account for the purchase of these 10,000 shares? Okay, well done. You are correct. We are going to be debiting our investment in Lifa and crediting our bank for 23,000. So how did we calculate the 23,000? We took the 10,000 shares and we multiplied it by the R2.30, and that gave us the 23,000. Okay. So these were our transactions for the year. They tell us here that the shares are to be valued at fair value through profit and loss. So what is fair value? Can anyone tell me what is fair value? What does it mean? Who can tell me what fair value means? Who was listening this morning? Okay, I can see a lot of you are getting it right. The fair value is basically the market value. So we looked at these transactions and we saw that at one point the shares were trading at R2.30, then the shares were trading at R2.80. So this is basically the price in the market. So we had transactions on each day and we would take the price on the date of the transaction. However, at the end of the year, we need to value our investment at fair value. So we know even though the shares were trading, or even though we bought the shares at R2.30 on the 1st of September, the shares are probably trading at a different amount now, okay? So it told us that we bought these shares on the 1st of September at R2.30. However, on the 31st of December, these shares were trading at R2.80. So do you agree there has been a gain here between these prices? But remember, we also had previous share purchases. We bought the 100,000 initial shares in Lifa at R2 per share. So what we need to do now, we need to calculate what is the carrying amount of our investment before the 31st of December 2018. What was the carrying amount of our investment? And this might seem a bit tricky, but let's go down to a calculation here. We need to calculate the carrying amount of our investment just before the end of the year, before we revalue it, okay? So we need to look at all of our share purchases and share sales. So in the question, that information I told you to ignore, you need to look just after that. So on the 1st of January, we had 100,000 Rand in shares, and the price of that was R2.50. Okay, so they said the shares were trading at R2.50 on the 31st of December 2017. How many shares did we have at the 31st of December 2017? We had 100,000 shares. So if we say that is the opening balance of our investment account, if we go 100,000 shares, we had these at the 31st of December 2017, and we multiply that by what the shares were trading at on the 31st of December 2017, that is going to give us R2.50 per share. So what is our closing balance at the 31st of December 2017? What is the carrying amount of our investment in Lifa on the 31st of December 2017? Okay, our carrying amount is going to be 250,000 Rand. So at the end of December, the carrying amount of our investment in Lifa is going to be 250,000 Rand. And we calculated that by taking the 100,000 number of shares, multiplying it by the price per share. So they were trading at R2.50. That is the same, that is, if you bought it at that date, you would have paid R2.50. So if we go to our table here, the opening balance on our shares is going to be 250,000. So remember our closing balance at 31st December 2017. This is the same as our opening balance. So our opening balance on 1st of January 2018 is going to be 250,000. Okay. Then we need to look at the transactions that took place during the year. So what happened to the carrying amount of our investment? Remember, we sold 20,000 shares. We recorded that journal entry. So what did that do to our carrying amount of our investment? So remember, we sold 20,000 shares, and when we sold them, the price per share was R2.20. So we sold this number of shares. So when we sold those 20,000 shares, remember we said it reduced our investment. We sold these shares, we debited our bank account with 44,000 Rand, and then we credited our investment account with 44,000 Rand. So that is going to reduce the carrying amount of our investment. Okay, I see your question. I'll get there at the end because I think I'll answer it in my explanation. So now that we sold those shares, that reduced the investment. Remember, then we got money and we decided to purchase 10,000 Lefa shares. So 10,000 shares times R2.30. We said we were purchasing these 10,000 Rand shares. So we know when we purchase something, our bank account is going to reduce. So we went credit bank account, debit investment. So our investment account here is increasing by 23,000 Rand. Now, all of these transactions, our opening balance less our sale of shares plus our purchase of shares, this is going to result in a carrying amount. And then we need to revalue that carrying amount at the end of the year. So if we go to the next page, unfortunately it's shown on the next slide. So if we add these together, our opening balance less our sale of shares plus our purchase, what is the Rand amount you are going to get of our investment? So if you take the opening balance of 250,000 less the 44,000, which is the shares that we sold, plus our 23,000, which we bought, you will get a carrying amount of 229,000. That is correct. But remember, that carrying amount was based on these prices here. But if we go to the question, the shares are trading at R2.80 per share on the 31st of December 2018. So we now need to essentially revalue these shares at the market price, which is known as the fair value. So if we go to the next slide here, remember that is the total you just calculated. And then they told us that the shares are now trading at R2.80 per share. So what is the fair value of the investment in Lefa at 31 December 2018? What is the fair value of these shares? So I'm asking you, what are these shares trading at currently on the 31st of December 2018? So we have 90,000 shares multiplied by the current share price of R2.80. That is going to give us a fair value of 252,000. So the shares should actually now be valued at the market value, okay? Just like if you bought a house and then 5 years later you sell that house, it's going to be sold for a higher price than what it was bought. And it's just the same for shares. There are fluctuations in the share price. Here, our fair value now of the shares is 252,000, whereas when we bought it, the carrying amount of our investment based on the price at which we bought and sold it for was 229,000. So we need to go from the previous carrying amount of 229,000 to the fair value, which becomes our new carrying amount of 252,000. So this is going to be a fair value adjustment to profit and loss of 23,000, which is the difference between our fair value at year end and basically the carrying amount just before year end. Okay. Let's look at the journal entries for this, just to make sure you're all on the same page. We have done most of the journal entries. So remember when we sold the shares, we sold our shares and you guys correctly said it was debit bank, credit investment, and that was 44,000. Then on the 1st of September 2018, we bought 10,000 shares and you guys mentioned correctly that we debited the investment and we credited the bank account and you guys all got the 23,000 Rand. Now we need to do our journal entry relating to our fair value adjustment. So remember that 23,000 comes from it comes here from the difference between the fair value at year end and the carrying amount just before year end. So we are simply taking the fair value at year end, subtracting the carrying amount just before year end, and that gave us 23,000 Rand. That is known as our fair value adjustment. And the journal entries for this would be debit investment in LIFA because it is increasing our investment. Okay, we are going debit investment in LIFA and we are crediting fair value gain. So remember they told us in the scenario, they said that the shares in LIFA are measured at fair value through profit and loss. So that is where we take it. Okay, our fair value gain is going to go to profit and loss, and our investment in LIFA is an asset. So that is shown in the statement of financial position. Okay, so that is financial instruments. Let's have a look at some of your questions. And I see some of you have been answering the questions, which is very impressive. Okay, let's just see most of the questions are answered. Okay, I think I answered your question, Rue. So where did we get the 90,000 shares from? Thank you, that is correct. We took it by taking the 100,000 shares. That was the initial purchase, less the shares that were sold of 20,000 plus 10,000 new shares. Okay, you guys are super smart today. Where did we get the profit amount from? Thank you. I see you've answered that. So if you have a look at this table over here, the 23,000 Rand profit, that is the difference between our current market price at 31 December 2018 and the carrying amount just before that date. Okay. So this is, I wouldn't necessarily say it's a profit on investment. So if you look at that 23,000 Rand, there's a question, can we say credit profit on investment? I don't think that is the best accounting terminology. I think you could say fair value gain because that is what it is. A profit almost sounds like you've sold the shares, but in actual fact, you can have a fair value gain here before you sell the shares. So we are holding the investment, and because of the way that the market moves, you're experiencing share price fluctuations. It is a gain, but we haven't realized that gain in that we haven't actually sold it, okay? We haven't sold the investment that we're valuing at fair value at the end of the year. So it's not necessarily a profit until we sell it, okay? Okay, guys, I think we need to move on. Profit is the carrying amount of, okay, I'm not sure I understand that question, but I would say use the terminology that you learned in your theory lecture. It is a fair value gain. Someone is asking, how did you get the 23,000 fair value gain? It is here. Okay, we calculated it as the difference between the market price at the end of the year and the balance just before that date. Okay. Well done, guys. I know that might have been a bit difficult because you only did the work this morning. But let's move on to the next question on intangible assets. Okay. Now, hopefully the intangible assets is going to be a little bit easier for you as you did it a while ago. The last question is, if the market price was below the price of the shares purchased, then you would have the opposite of a gain, okay? You would have to like devalue your investment. It is possible that it happens because share prices fluctuate. So then you would have a fair value loss in that situation, okay? That you would recognize in the statement of financial position. Sorry, statement of comprehensive income. Because they've told you it is through profit and loss, your fair value adjustments will go to your statement of comprehensive income. Okay, let's move on, guys, to the next question. Okay, so this is a question on intangible assets. Not sure why it is. Oh, there we go. So we have a company here called Diners. Diners Pty Limited has a reporting date of 31 December. On the 1st of January 2019, the entity acquired a franchise license for 3.392,500, okay, just over 3.3 million. And this amount was including VAT. They bought it from Quota Kings. The license will enable diners to make and sell quotas in their restaurant. The sale process took longer than expected, and Diners was only registered as a franchisee of Quota Kings and received the license on the 1st of June 2019. The entity paid 57,500, including VAT, registration fees on this date. Diners incurred 50,000, excluding that, to train its staff to make the quotas, and 100,000, excluding that, to advertise these new quotas. Management estimates the useful life of the license to be 10 years. Now, the first question is, assuming the entity is not a registered VAT vendor. Keyword here is not. So assuming the entity is not a registered VAT vendor, calculate the cost of the intangible assets. Who can assist me here? So remember, we want to calculate the cost of the intangible assets. What is going to be included in the cost? It says here, Diners incurred 50,000 to train its staff. Are we going to include training costs in the cost of the intangible assets? Okay, you guys are correct. We may not include training costs in the cost of the intangible assets, okay? So that 50,000 in training costs is not going to be used, okay, when we calculate the cost of the intangible assets. Then we spent 100,000 Rand on advertising. We wanted to advertise our new quotas. Are we going to include that 100,000 Rand in the cost of our intangible assets? This 100,000 Rand relates to advertising. Okay, you are correct. We may not include the training costs in the cost of the intangible assets. So now that we have established that we may not include advertising and we may not include training, are we going to include our license here of 57, our registration costs, someone's finger's in the way, our registration costs of 57,500. Are we going to include the 57,500 in registration fees? Yes, we are. Okay, this is necessary in order for us to get the intangible asset in a state that it can be used. So yes, we're going to include the registration fees. And the cost of our franchise license, this was just over 3.3 million. This is obviously also going to be forming the cost of our intangible asset. So in this case, our intangible asset is the franchise license. Why is it an intangible asset? It's an intangible asset because it cannot be, it's not physical. It's not like PPE or inventory, which you can touch and feel. This is not a physical asset, which makes it an intangible asset. Now, someone is asking, Ramatlo is asking, don't we exclude VAT? And that is the next point that is the next point I'm going to discuss. If our company Diners is not a registered VAT vendor, can we claim the VAT that we paid? So we paid 57,500. That amount includes the VAT, okay? Can we claim any portion of this 57,500 back if Diners is not a VAT vendor? Okay, we cannot. So because we have a company here, I see someone is drawing on my picture here. I can see someone wants to be an artist. Okay, so because we are not a VAT vendor, Diners is not a VAT vendor, they cannot claim back any of the VAT that was included in the purchase price, okay? So this amount is including VAT. If Diners was a VAT vendor, then yes, they could claim VAT back and we would take the VAT portion out. But here, Diners is not a registered VAT vendor. So they cannot claim any amount back over here of the 3.3 million, and they cannot claim any amount back here of the 57,500 Rand. Okay, that is the amount they paid. They're not claiming any VAT back on that amount, so it's non-refundable. So let's have a look at the solution for the first question. So we said our purchase price was 3.3 million here. What are you guys doing with your hands? Come, put your hands away. Put your hands away and concentrate, please. So our purchase price is 3.3 million. We said that was including that. We said it is non-refundable, so it cannot be claimed back. You correctly said the staff training. The staff training could not be included because it is not necessary for the intangible asset to be used, okay? And the advertising as well. There's not going to be any probable inflow of benefits from the advertising, so we cannot include that in our intangible asset. The registration fees, yes, we said this was necessary for our intangible asset to be used as intended. Remember now that we must leave the amount as is. Why? Because even though these amounts here are including that, because our company, Diners, is not a registered VAT vendor, it means they cannot claim the VAT back. When you go to the shop to buy chocolate, there's VAT included in that price. If you are buying a lunch bar chocolate for 20 Rand, there's VAT included in that price. You are not a registered VAT vendor, so you cannot claim that VAT amount back. The 20 Rand is the amount you paid for it. If someone bought the chocolate for 20 Rand and they were a registered VAT vendor, maybe they were going to on-sell it, then they would be able to claim the VAT on that 20 Rand back. So the price then is less for them. But because here, Diners is not a registered VAT vendor, we cannot claim back the VAT in these amounts. So this is the price, okay? So our total cost of intangible asset is 3,450,000. Okay. So you leave these amounts as are, including the VAT. You cannot claim it back. Okay, so someone is saying they say the entity is not a registered VAT vendor. Do we always put the purchase price as inclusive of VAT? I think you have answered your own question there. You need to see if they are not a registered VAT vendor, then if you pay for something and it includes VAT, that is your purchase price including VAT. If you are a registered VAT vendor, then you would need to strip out your VAT. Okay, let's carry on, guys. So the next question is calculate the amortization expense at 31 December 2019. Okay, so we want to calculate our amortization. We have just calculated our cost of our intangible asset as 3,450,000. Can you tell me what the amortization is on this intangible asset? So what is our amortization? Remember, just like we depreciate an item of PPE, intangible assets also need to be written off. But obviously, when we have an intangible asset, we call it amortization. So these intangible assets will be amortized, and you guys are correct. The amortization is going to be over 10 years. So they told us in the scenario, management estimates the useful life of the license to be 10 years. So this is the useful life. So we are going to write it off over 10 years. This is referred to as amortization. And this is different. We cannot depreciate intangible assets. We depreciate PPE, like physical assets, vehicles, computer equipment. But when we need to reduce the carrying amount of an intangible asset or reduce the cost or write it off over its useful life, it is referred to as amortization. Okay. Sorry, guys. So you are correct. The amortization is going to be 201,000 and a little bit of change there. Let's just have a look at that time period. Why are we amortizing the intangible asset for 7 months? What date do we start depreciating the intangible asset? So what date do we start depreciating the intangible asset? Okay, we start amortizing it. I'm mixing up my words here. We are going to amortize the intangible assets from the 1st of June until the end of the year, being 31 December 2019. So how many months is that? So it's June, July, August, September, October, November, December. It is 7 months, okay. So when we amortize our intangible asset, we are going to take the cost of the intangible asset, which we calculate was only amortized for 7 months out of the year. And that is because it was only brought into use on the 1st of June. Okay. Okay, so the cost of the intangible asset was 3,450,000. The intangible asset had a 10-year useful life, and because we brought that intangible asset, we brought it into use on the 1st of June. It means we are going to amortize it for 7 months out of the current year. So we're going to take the cost divided by the useful life of 10 years. And because that intangible asset was not used for the whole year, we are just going to amortize it from the date that we brought it into use. and that was 7 months. Okay, so that will give us our amortization of 201,250 Rand. Okay, so let's have a look at the next question here. Let's see how smart you are. Assuming the cost of the license is 2 million, excluding VAT, and the entity is not a registered VAT vendor, the accumulated amortization is 300,000 and the accumulated impairment is 200,000 at 31 December 2019. How would the intangible asset be disclosed in the statement of the financial position? So my question to you is, what is the amount that our intangible asset would be at 31st December 2019? What is the amount that so now assume that the cost of the license is 2 million. Okay, if you got this wrong, the 3,450,000, we are now telling you to assume the cost of the license is 2 million, excluding VAT. The entity is not a VAT vendor. The accumulated amortization is 300,000 and the impairment relating to the intangible asset is 200,000. So what would the intangible asset, what amount would it be disclosed in the statement of financial position? Okay, I'm going to give you 30 seconds to think about that and type your answer in the chat and then we'll go through it now. Okay, I'm seeing some answers. It is a bit of a tricky one and you have to be wide awake to get this one. Let's have a look. So if I'm telling you that the cost of the license is 2 million, excluding that, and the entity is not a registered VAT vendor, what is the cost of the intangible asset to us? So if we were told that the license excluding VAT is 2 million, and we are not a VAT vendor, okay, licenses are not VAT exempt or zero rated, so there would have been VAT included in this when we bought it, but they are showing us the price excluding VAT. So we actually need to include the input VAT we would have paid on this license. What is the current VAT rate in South Africa? Okay, the current VAT rate is 15%. So we are going to now take this 2 million Rand excluding VAT, and we're going to include the VAT because we are not a VAT vendor, okay? Some items that we purchase, like bread and maize meal, there are some items that you can purchase that are either VAT exempt or zero rated, meaning they don't have VAT included in them, but a license is not one of them, okay? So when we buy a license from someone, there's going to be VAT in there, but they are giving us the price excluding VAT. So we now need to calculate what our input VAT is, and we want to get the purchase price including VAT. We cannot claim that VAT back because we are not a registered VAT vendor. So are you all happy that our price is going to be 2.3 million, including VAT? Okay, our price is 2.3 million, including VAT. So let's go down now to the next thing they are telling us. They are telling us our accumulated amortization is 300,000. So we're going to minus the 300,000. Okay, that is our accumulated amortization. Our intangible asset is going to be disclosed at the carrying amount. So we are basically calculating the carrying amount of our intangible asset. So we calculated the cost including that of 2.3 million, less the accumulated amortization. So remember, when we have amortization, that reduces our cost of our asset. So as we amortize our asset, our carrying amount is going to be getting smaller. So we are subtracting our accumulated amortization. Then we have accumulated impairments of 200,000. So remember, we need to see if there was any impairment on our intangible assets. And if there was, which is what they're telling us, our accumulated impairments is also going to reduce the carrying amount of our assets. So if we take our cost price, including that of 2.3 million, and we subtract our accumulated amortization, and we subtract our accumulated impairment, we are going to get a total carrying amount of 1.8 million. And I did see some of you get this, which is very good. I can tell you're concentrating. If you didn't, it's fine. Just make sure you understand and you're looking out for including, excluding that. Okay, so our total carrying amount is 1.8 million. And then we are going to disclose this in our statement of financial position. So if we go to our statement of financial position, remember, an intangible asset is a non-current asset, okay? It is not going to be realized within 12 months. It is a non-current asset, so we're including it under non-current assets. Our non-current assets fall under our assets group. So our assets will have your current assets like your bank, your debtors. They will also have non-current assets. And we're going to include our carrying amount of 1.8 million over here. Okay, are you guys happy with that? Do you have any questions on this intangible assets question? Okay, guys, well, that is it from me. So we have revised our borrowing cost, we have revised our intangible assets and our financial instruments. You must go home and make sure you have revised PPE because it is also important for this assessment. So someone is asking about the discount. If the purchase price includes VAT and there's discount, must the discount be subtracted before or after deducting the VAT? Well, it really depends if the person buying the intangible asset is a VAT vendor or not. So we need to ask ourselves, well, how would the discount have been calculated? Okay, maybe it's a percentage of the price. Maybe it's a set random amount, but it's important to see if they're giving you the amount of the discount, and you need to look in the question and assess, is the person purchasing, are they a VAT vendor or not? Okay, the question would give you guidance on what to do, whether it's a person who is going to be claiming that back or not. Okay. How many units are we writing? So you're writing on unit 2 to the unit you covered this morning. Okay, so that's 4. Have a look at your emails just to make sure you have read all the correct emails and you're aware of the scope of the assessment. Look at that practical question that should be available on financial instruments, and please attend your tutorials. And I think there's a session on Friday with the tutors as well. Okay. Someone is asking, and this is a good question, did we assume that the accumulated depreciation and impairment was excluding that? Okay, so that is a good question. if we have a look here, so remember, what is the amortization? So how do we calculate the amortization? It is basically calculated on the cost price, okay? So if our cost price included VAT, then the amortization is basically a function of that. And if our costs excluded VAT, then our amortization is based on that, okay? So our amortization, it doesn't really include or exclude VAT. It's simply a function of the purchase price. So in this example here, because we didn't have someone who is registered as a VAT vendor, meaning they cannot claim back VAT, we needed to include the VAT. And then the amortization is basically a function of this, okay? So we don't usually express amortization in terms of including or excluding VAT. It's a function of the cost price. So it's more important to get the cost price correct and see if that should be including or excluding that. Okay, do you have a practical session today? Yes, you do. That is at 3:30. So let me say goodbye if you have no more questions. If you have any questions, please consult with either the tutors or email one of the lecturers, and we will do our best to assist you. Please make sure if you have questions, you are sorting them out in enough time, okay? Don't leave your questions till midnight before the assessment, because we may not be able to assist you at that time, okay? All the best for your assessment on Wednesday. I'm not going to see you until then, but please study hard this weekend. You have Monday and Tuesday as a holiday. Please use them wisely, okay? I will upload the solutions to the session, and I will also upload the recording, okay? All the best, students.